In this video, I will show you the 10 stocks that are priced ridiculous and could be dead money the coming years. I will show you the forecasted revenues, the forecasted EPS, what the forward PE would look like, possible stock price for those years, with a bull case, a bear case, and a base case. The first stock is called Palantir, and Palantir got massive momentum lately. Obviously, the company is executing extremely well, but the PE ratios of this company has gone out of control. And I want to show you that with these projections. So here you will see the expected revenues for the coming years, starting with 4 billion in 2025, going towards basically 10 billion in 2028. So that's more than a 2x. So it obviously should have a high PE ratio, but let's first look at the EPS growth, going from 44 cents in 2025 to probably around $1.2 in 2028, which is basically a 3x, which is also amazing. And this will bring us to the forward PE ratios. The 1-year forward PE ratio is 300, which is absolutely insane. The 2-year forward PE ratio is 180, and the 3-year forward PE ratio is 150. Obviously, this company should trade at a much higher PE ratio than most of the companies. I would say, knowing that this company will grow on average, let's say 40%, this company definitely deserves a PE ratio of 100 with those margins. But you can see over here, this company is trading way too expensive. So keep that in your mind if you own or want to buy Palantir stock. I personally don't own any of these stocks that I'm mentioning in this video, but I do know that these are pretty popular. Next up we got Tesla, and everyone knows that Tesla is trading very expensive right now. That's because they're pricing in the potential robotaxi build out, but that will still take years before you see it in the numbers. And on top of that, our analysts also pricing in the Optimus robots potential, but it is also years in the future. So for now, we're only counting in the revenues of the car and the energy business. This stock is really crazy, but first smash that like button. I did a ton of research for you guys and I would really appreciate that. So for the revenues, our analysts forecasting that they will grow 17% every year on average, but I wanted to be a little bit more bullish. So in my projections, I did a 20% revenue growth with a 35% EPS growth. Furthermore, I want Tesla to be trading at a 90 PE ratio, even though that's ridiculous for a company that's growing their revenues 20% on average. But in the end, it's still Tesla and it will always trade at a massive premium. And if we're looking at the price projections, you can see that the stock price in 2028 will be $330. And that means after 3 years, the stock price will decline 25%. And that shows you that the company's valuation has gone out of control. And you can literally see it right now. The PE ratio at the moment is 240. Absolutely ridiculous compared to their growth rate. As you can see, their earnings per share forecast for the upcoming year is a 26% decline. And they're expecting to grow their revenues 2.8% the coming year. Now, I'm pricing a little bit more growth because with the new models that are coming out, with maybe very little robotaxi revenue in 2028, shows you that it will still be overvalued. So yeah, Tesla is just not a very attractive stock to own or to buy, and I wanted to show you guys that with these projections. The next stock is called Walmart. It has now a 40 PE ratio. Furthermore, if you look at their revenues, in the base year of 2025, they will generate 670 billion in revenues. And if you look at analyst projections of 4 to 5% revenue growth every year, the company will reach 770 billion in 2028. So having a PE ratio of 40 while you're growing your revenues 4 to 5% every year is ridiculous. Here you see the EPS projections, basically growing 10% every year. And this is even more interesting because you see the forward PE for every year. So the 1-year forward PE is still 40, the 2-year forward PE is 35, and the 3-year forward PE is still in the 30s. So it's still very expensive for these coming years. The typical PE ratio for the sector that Walmart is in is 22, as you see over here. Then you got Walmart, which is usually trading at a premium of 25 on average, and the bull case has a PE ratio of 28 in case they're growing their revenues faster than 4 to 5% on average. Now if you take the EPS and multiply that by the PE ratio, you will see here the calculated stock prices for the coming 3 years, and in the most bullish scenario, the stock price will be $92. Now looking at the stock price today, it's trading at $102. The last 3 years, the stock made an insane run of 140% increase. Now let's say the market stays risk on for the coming 3 years, where it will be trading at a PE ratio of 40. Then the stock price will be in the most bullish scenario $120, which is a 20% increase in 3 years, which is absolutely nothing. And that is why Walmart is dead money and possibly a massive money loser if we head in a shaky market. The next stock that's not looking too great is called SoundHound, and I will tell you right now why. So the revenues will go from 160 million in 2025 to 300 330 million in 2028. So that's basically a 2x, which is obviously great. But here comes the troubling part. The 1 year, the 2 year and the 3 year forward PE doesn't exist because this company won't be profitable for a while. Now let's say in the most bullish scenario, this company will become profitable in 2027 with steady margin expansion. Then this company will reach in the most bullish scenario with a PE ratio of 55, $33. This company right now is trading at $18, so that means you will double your money in 3 years, which is great. But this is in the scenario where they will become profitable, which is not certain for 2028, and with the highest possible EPS. Here you by the way see the 3 different EPS the company could have. And yeah, looking at 2028, only these scenarios will have a modest increase in the stock price. So in my opinion, SoundHound is trading very expensive. And by the way, apart from PE ratios, there's one more metric which is called price to sales ratios, which will show you why this company is still very expensive. The company right now is trading at a 55 price to sales ratio, which is absolutely insane. Their 1 year forward price to sales ratio is 35, their 2 year forward price to sales ratio is 27, and their 3 year forward price to sales ratio is 23. These are all very high price to sales ratios, and those future projections are not going down fast enough, at least in my opinion. The next stock is called ARM, and ARM Holdings is also trading very expensive. Right now it's trading at a PE ratio of 260, which in my opinion is very scary compared to their growth rates. And for their revenues, analysts are forecasting that their revenues will grow from 4 billion in 2025 to 7 billion in 2028. So basically a 25% increase on average, but that doesn't deserve a PE ratio of 240. But still with those growth rates, their future forward PE ratios are insane. Their 1 year forward PE ratio is 180, 2 year forward PE ratio is 100, and 3 year forward PE ratio is 70. Same with the price to sales ratio, 1 year forward price to sales ratio 35, then 29, and then going to 24 and 28. That's extremely high. This company should be growing their revenues at least 40 to 50% every year to deserve these multiples, and ARM is definitely not doing that. If we're looking at the price projections, we have 3 different PE ratios. I want to make a 4th one with a PE ratio of 70, which represents the very most bullish scenario. That means it will be double this price, so $160. While right now it's trading at $155, so it will be basically dead money. So I would definitely be careful with touching this stock. The next stock of this list is called Duolingo. Looking at the revenues of Duolingo, in 2025 their revenues will be basically $1 billion, and in 2028 they will generate $1.8 billion, and that's basically an 80% increase, which is still a very nice performance, so it should have a high PE ratio, but not as high as it's trading right now. At the moment the PE ratio is 130, which is quite high if you ask me, and on top of that they have a price to sales ratio of 17, which is also really high. Now looking at the EPS projections, in 2025 it will be $3.33 basically, and in 2028 it will be $8.25. Yeah, that's basically a 150% increase in their EPS. Now looking at the price predictions, if it's trading at a 30 PE ratio, which is basic for this sector, the stock price will be $250 in 2028. Well, that's a money loser basically. Now this company obviously has quality growth, so it definitely deserves a 40 PE. Then the stock price will be $330 in 2028, which is basically no increase in the stock price. And if it's trading at a PE ratio of 55, which is an AI premium, the stock price will be $450, which is a 25% increase in the stock price, which is alright, but honestly in 3 years I wouldn't be too happy with that performance. If you appreciate my efforts, smash that like button for me, and only subscribe if you want to see more future videos.